The Dental Download Podcast is your source for insight into dental school, conversations with dentists, specialists, and leaders in the industry. With new episodes every Monday morning, I'm your host, Haley Schultz. Let's get into this week's episode. Hello, everyone. Welcome back to another episode of the Dental Download Podcast. This week, we have a topic that I think is super important for us dental students to learn about as early as possible and become more familiar with, and that is taxes. Taxes as a dental practice owner. So Morgan Hammon joins us this week to share some insight into when you would start working with a tax accountant and the difference between having the tax accountant in your team versus your own financial planner versus a financial planner for your actual business versus what you'd have a lawyer for when it comes to buying and selling a dental practice. Really just another great episode when it comes to things to do with dental business. But before we get into that episode with Morgan, I did want to quickly recap this past week. As you could imagine, not too much happened academically because we had Thanksgiving. If you're listening in another country, Thanksgiving in America was this past Thursday, November 25th. And I just had lab on Monday from 2 to 5, where I was able to complete a few more steps of what we're working on is mounting an impression cast of a tooth that's going to get made into a crown, basically. So we mounted our crown prepped mandible, and then we're also mounting the maxilla on an articulator. We had to saw down the cast to make a die of the specific tooth 30, and kind of trim that die so that the margins were really clear, as if you were sending all of this to a dental lab. And then we also started the process for milling them through these scanning systems, so we can kind of compare traditional, conventional way of doing things to the more modern and fast and enjoyable way of doing things, which is digital dentistry. And this upcoming week, I have one more day of sim lab and then a practical on Wednesday. I have a standardized patient interaction on Thursday and diagnostic mounting on Tuesday, as well as a case study for my diagnostic radiology class. So pretty busy early week, but Thursday and Friday should be pretty light, and I'm not going to be doing too much for school. I'm going to try to really push myself Monday through Wednesday to do a lot of studying, because the following week, starting December 6th, is when our finals begin. That week we have 3 finals, and then the following week we have 6 finals. So I'm going to try to do a lot of studying early this coming week for those exams, and then the following week will also be a ton of studying since there'll be 6 upcoming after that. But this week, really a lot of school, and really the rest of the semester, a bit of a step back from clinical things and more focused on those lecture classes and studying and watching lectures and reviewing and making study guides and trying to connect all these concepts so that I can perform well on our exams that will be coming up in December. And next week's episode, I want to let you know what to look forward to, is going to be a solo episode. I thought it would be good timing with everyone approaching finals, and it is how to make it through a tough week or a busy week, whatever you want to call it. Just some of my tips for time management, for stress relief, for, I guess, in general, like also letting you know what kind of a crazy week can look like in dental school. I can kind of reflect on some of my tougher weeks and what went well, what didn't, and what I do now compared to first year. So that's going to be next week's episode, solo episode, and then getting into December, we're going to have a mix of guests and solo episodes as usual. So let's get into this week's episode with Morgan, all about taxes. Want to make a podcast? Spotify's got a platform that lets you make one super easily and then distribute it everywhere and even earn money, all in one place for free. It's called Spotify for Podcasters. Here's how it works. Spotify for Podcasters lets you record and edit podcasts right away from your phone or computer, so no matter what your setup is like, you can start creating today. Then you can distribute your podcast to Spotify, but also everywhere else podcasts are heard. Video podcasts are also available, and you can earn money in a variety of ways, including ads and podcast subscriptions. Did I mention it is totally free, no catch? I've been using Spotify for podcasters since the very beginning of my show, and now we're nearing our 200th episode. So I can definitely say it's an easy platform, and I've really loved using it. So be sure to download the Spotify for Podcasters app or go to www.spotify.com/podcasters to get started. Hi, everyone. We have another guest here today, and I'm going to let Morgan introduce himself.
Hi, thanks for having me. Really appreciate it. My name is Morgan Hammon. I'm a CPA, co-founder and president of HD Accounting Group, and we do financial accounting and tax planning for privately owned dental practices across the country. So about 500 clients in just about every state, and our mission is to take care of dentists that enjoy being dentists and own their business and want to know that the accounting's being done correctly every month and want some visibility on their practice's profit performance each month. And then, of course, stay on top of the taxes, which includes tax planning, so we can plan ahead, make sure we're not leaving any money on the table for the government, and then no surprises year end is our big kind of overriding objective. So, but yeah, that's who I am and what we do, and I'm real happy to be here.
Yeah, thank you for your time. So before we get into some of your advice for dental students or new dentists, could you just give some background on why your accounting firm works specifically with dentists? Where did that mission kind of come from for you?
Sure. So I co-founded the firm with my dad, Ken, back in 2009, and we always had envisioned we wanted to be business oriented. We never wanted to be just out there doing personal returns, knocking out 1040s like an H&R Block kind of firm. We wanted to be business advisors, and we always wanted to have a specific niche. And just through a bit of circumstance and luck, we were working with a number of dentists, and it felt like a really good fit. And so kind of early on, about 2010, 2011, we just went all in on dental and focused just exclusively on that niche. And that's honestly, as a CPA, that's the only way I would want to do public accounting. Because when you're dialed in on a very specific niche, you're just your depth of knowledge is very deep for a narrow segment of the tax paying business owner population. So we're just in a much better position to help people realize more profit from their business. And then also when it comes time for tax, we really know what works, for this one kind of narrow segment of the tax paying public. But yeah, getting into dental, it was just a bit of luck and realizing it was an opportunity and seizing on it. And I wouldn't do it any other way.
That's great. I think that everyone, if they're going to be going through an accountant for their practice, it's really important to find someone that specializes in dental like you guys.
Yeah, certainly. I can't imagine being a CPA and you've got just the scatter shot of clients. And so like, who am I talking with next? Oh, they have a dry cleaner. All right, well, I just talked to whoever at a car lot. Like, how do you even know? How do you even know what their metrics are supposed to be? And I think the sort of the general CPAs out there that do work that way, they're mainly going to be a tax shop. They're just going to be cranking out tax returns during the year. Because how do they really know how to advise on business profitability if they're not just in the trenches, with their clients all year, kind of just realizing, not only what their financials look like, but what they're going through and what the proper financials are supposed to look like. And if something is off, how to diagnose and fix that. So that's I think what we're really different from the kind of the tax chop shop, as I sometimes think of it, where they're just cranking out tax returns for half the year and then kind of twiddling their thumbs in the fall. Definitely not how we do it.
So you've mentioned some advising that you all do and how you're kind of taking a look at a practice, seeing where you can save money. How does what you're doing as an accountant differ from a financial planner? And do dentists need to have both?
In my opinion, they need to have both. Now that there is a trend in the CPA world where CPAs they're going and getting licensed and then wanting to manage assets in addition to doing the accounting and the tax. And I think the trouble why we haven't done that is you can't be everything to everybody. And I look at our niche and what we do. Um, Financial planning is a totally separate discipline than tax or even financial accounting. And so I don't know. I'm just very cautious about wearing too many hats. The financial planner, to answer your question very specifically, like my role as the dental CPA is there's really, if you kind of boil it down, there's two things we're trying to do. First and foremost, owning a business, it's difficult, it can be stressful, and there's risk involved. And so to undertake that journey, it has to be worth it. That's the reward, in our capitalist society. You take risk and then there's the upside for the reward. Well, that reward is profit. And how we measure that is practice profitability. That has to be adequate and appropriate. So our mission is to make sure that that's happening. In other words, let's make as much money as we can from this business. What does that look like? Well, for single doctor owner operated practices, that profit margin needs to be 35 to 40% minimum. So that's step one. Let's make an appropriate amount of money, for what the business should be capable of providing. And then once we've made that money, now we want to hang on to as much of it as possible. Right? And that's tax planning. Right? And tax avoidance is perfectly legal. That's our obligation. There's a difference between tax avoidance and tax evasion, even though they kind of sound the same. Tax avoidance is, we do that all day. We avoid as much tax as possible within the code so that we can keep as much of that money as possible. And if we're successful in these two endeavors, then we're going to end up with this residual cash that needs to be distributed home. And as a business owner, we want to see lots of distributions. It's why you go start a practice or buy a practice. So once we have that residual cash, we've distributed it, we've taken it home. That's where there's the baton is handed off, in my opinion, to the financial planner. So they're going to take that money that you're now holding personally, and then they can decide, are we going to invest that in stocks, bonds, real estate, however that dentist wants to build wealth. That's I think the dividing line between the dental CPA and the financial planner. We are going to help them earn and keep as much money as possible. And then once they have that money, then they can work with the financial planner to decide how they're going to save and make those dollars work for them and make it grow. And I think those are two separate disciplines, in my opinion.
That makes a lot of sense. Thanks for breaking it down for us. I also agree with everything you said as well. So, for our dental students listening, do you have one piece of advice that comes to mind that you'd like to offer them?
So my world that I have visibility on, it's practice owners. So when probably the earliest time I'm in contact with younger dentists is when, they are typically associating at an office and they're wanting to get into ownership, whether that's the full like de novo startup or they want to purchase a practice. And there's pros and cons either way. So I would say, going back to like a dental student, I would say my advice would be, I would really think twice about going into ownership like right out of the gate. That's rare. I don't see it that often, but I would encourage the students to, once they graduate, associate somewhere, learn as much as you can on someone else's ticket, so to speak. Right? And then I don't know what period of time that is. A couple of years. We've seen the whole spectrum. Doctors that try, get into ownership real early. Maybe they associate a couple of years. Maybe it's 5 or 10 years. I would say it's up to whatever works for that particular individual. But I can say I think you can draw a correlation with new business owners. If they've associated somewhere for a couple years and have just learned as much as they can during those years, paying attention how the practice is running. What do they see that they like? What do they see that they don't like? Watch the current owner. There's the clinical skill set and the business owner skill set are completely different things. Watch how that owner, watch their leadership styles, watch their business management styles. Decide what you like, what you don't like. Maybe I really like that. That's something I would do. Or I can't believe this person said this in front of the staff. Like I would never say that. So just be a sponge. And then when you're just tired of the associating gig and you're ready to move into ownership, I would say, start going down that path armed with all that knowledge you've absorbed. And kind of just circling back, I think you can draw a correlation in success with new business owners if they've gone that route. And I've seen a couple instances where new grads just go straight into ownership, and it's a little more dicey. I like, my advice would be just go somewhere, be a sponge, learn as much as you can while someone else is paying the bills, and then armed with that knowledge, then go into ownership.
Kind of following up on that, do you think it's important for dental students to have their loans totally paid off from school before they go into buying a practice? Or
That would be
depends?
nice. That'd be nice, but I think it's rare. Most all our clients I visit with have student loans. And so and the reason I know that is because the question comes up, when they're doing well and they have some excess cash, if debt reduction is the strategy, it's like, well, which debt do we start with? And the answer is always distribute the money home and pay off the student debt. Most of the time, the doctors make too much money to obtain any type of deduction on the personal side for the student interest. And so that student debt is just an albatross around their neck, whereas the business debt is, the interest is fully tax deductible. So at least the government's helping subsidize the payment of that loan. So another question that can come up as well, when you own a business, can you deduct the student loan as a business deduction? The answer is no, expressly forbidden in the tax code. It's not even a gray area. It's a red line, so to speak. So you cannot deduct student loan as a tax deduction. So it would be, in a perfect world, would love to go into ownership with no student debt, but I think that's rare. And so, and I wouldn't say having a student loan should hold you back. And it can be a little bit of a gut check, if you're going to take out a loan for a startup or practice acquisition and you have the student loan still, it can be a big number. But the earning potential as a business owner is many times greater, in my opinion, than as an associate. So it's okay. And then over time, if you build up some extra cash, then we can take out those student loans. But probably the long answer to your question there, would love to see no student debt, but I think that doesn't happen very often unless somebody was, perhaps a military doc, where they had their dental school paid for.
That makes a lot of sense. I expected that, but it was good to have some of the clarification about if people were wondering about write-offs and everything. So one thing that I am frequently thinking about is how an owner dentist can set their salary, and how do you determine what makes sense for like being in a different tax bracket perhaps, or something. Like, what's the best way to go about that?
So first we'll start with a key concept on paying yourself as an owner, and it's kind of regardless of what the objectives are. The cruel reality, as a business owner, is that the business owners get paid last. So you might say, well, I want to pay myself as an associate. I just had this visit with this week with a doctor looking to buy a practice. And his question to me was, well, I have a certain amount of bills to pay and I need to, so I'm going to want to just pay myself as an associate from the practice, when I own it. And I said, that's great. There should be enough money for that. But just realize, as a business owner, you get paid last. So if something breaks and you need to, maybe buy a new sterilizer or whatever, you can't distribute and take money home as a business owner that you don't have. So with a startup, obviously there's going to be a period of time where there just isn't going to be money to pay yourself. And even with an acquisition, maybe we bought a shell of a practice that failed or just never really took off, and you might need to fund it for a while, or just kind of not, there won't be money to take home as an owner right in the very beginning. So first and foremost, yeah, owners get paid last. You can come up with whatever pay structure you want for yourself or how you want to do that. But the owner doesn't get paid until all the bills are paid. Now, in terms of how to pay yourself, how to structure that pay, and we're talking salary, it's really important to understand a key concept here. When you own a business, you're going to have a legal entity. And in every state other than California, that entity, in my opinion, should be a limited liability company, or some states will want it to be a professional limited liability company, a PLLC. They're the same thing. It's just in some states, if you're a doctor, accountant or attorney, professional service provider, they want it to be a PLLC. In California, you have to start as a corporation. That is your legal entity. And it is important to realize that there's a difference between your legal entity and your tax classification, two totally different things. So if you're a PLLC, which is going to be most states, and there's one owner, which is most of the time, we're talking owner-operated dental practice, that's going to be taxed as a sole proprietor. All right. And as a sole proprietor, you do not go on salary as the owner. You take money home via, it's called a distribution or a draw. It means the same thing. It's just whatever cash is left in the practice, you just take that home. Take it straight home. If the practice is fully profitable, and what I mean by that is there's nice six-figure income for the owner, so I would say 200,000 and up, then the better tax classification is S corporation. Right, so that PLLC stays a PLLC. You just elect to tax it different with the government, and that's a one-page election that we take care of for our clients, and says we're going to now tax this entity as an S corporation. Then and only then do you go on W-2 salary as the owner, and that's simply for tax planning, because as an owner of an S corporation, you're going to pay your payroll taxes on the owner salary, but then the residual distributions that you take are not subject to payroll taxes. And that's where that savings comes in with an S corp. That only works if there's ample profit. So that's just a little bit of structure on how we take money home. So if someone's doing a startup and they're a PLLC, tax sole proprietor, and the practice starts generating some cash, you don't go put yourself on payroll. You just write yourself a check, and that's something where talk to your CPA, and they should help you with that. We certainly will. So with that in mind, we can talk about how to structure the dollar amounts. Okay, and I realize I just put out kind of a ton of content. Was that clear? Do you have questions on what is there any points that you think might help make that more understandable?
I think that was pretty clear, actually. I
Okay.
appreciate it. Yeah, it was easy to follow.
Okay, so now, so let's just, as an example, let's say somebody just started up and they're a PLLC, they're tax sole proprietor, and we're finally, we're to the point now where we got a pile of cash in the operating account, and it's time to take some money home. That is, in my opinion, there's a procedure here, and step one is we need to decide what is the no lower than balance to be in that operating account, the operating cash reserve. And we want that balance to have enough money where we can pay bills as they come in and not really have to stress about the cash. But you don't want too much money in there because, let's face it, the doctor earned it. Let's take some home. We don't want too much money in there. So you have to quantify what is that no lower than balance, and some of that will be just a gut level feel as a business owner. You might say, you know what, if there's less than 50K in that account, I'm just not going to sleep well at night. That's part of it. But I think you can really dial that number in with some data, and the data we use to advise on that is what we call the break-even point of the practice. The break-even point, just like it sounds, is the amount of money you need to pay all the bills every month, pay all the employees, marketing, rent, all that. That's before any money comes home to the owner. We also have to include the full bank payment, the full loan payment in there, so that you know the true cash requirement each month just to keep the doors open. With a startup practice, I can tell you right now, just on day one, that break even is usually 20 to 25K per month just to be open. So once we know that break even, then we think about the cash reserve should be a multiple of that. Pre-COVID, before the pandemic, our client average is about 1 to 1.5 times break even. So if a practice, say they're collecting 85 to 90,000 a month on average, the break even is 50K, they would keep about 50K in the bank account. 50 to maybe 75, up to the owner. Just decide what that is, plant the flag, and that's any money that accumulates over and above that set cash amount is fair game for distribution. Post-COVID, most practice owners are keeping a little more money in the bank just through this crazy 18 months we've been through. They're keeping 2.5, 3 times in there, I'd say on average. So what does that look like as an example? Let's just stick with that example I just had. We're collecting 85K per month. We had a 50K break even, and the doctor's comfort zone for a cash reserve is, say, it's 75. Like, we talked on the phone, we said, yep, 75 is appropriate. We can just pay the bills when they come in. We don't have to stress about cash. And so at the end of the month, we log into the bank and we see there's 100K in the operating account, and our no lower than amount is 75K we're comfortable with. What that means is there's 25 grand that is fair game to distribute out. So they could either write a check for 25,000, take that home, that's your monthly income. But keep in mind, if there's something we're saving for, maybe there's a new piece of gear we've had on the to-do, and we don't want to finance, we just want to pay cash, and maybe that piece of gear costs 10,000. Maybe it's okay, there's 25K of extra cash. We're going to buy our piece of gear for 10, and then we're going to distribute 15. So that's the process. That's what, and regardless of how the practice is taxed, at the end of every month, as a business owner, the bulk of your profit should come home via distribution, and it's simply going to be the difference between the cash that is accumulated and what the business owner's desired cash reserve is. Any excess cash, take it home.
So I would imagine if someone is doing a startup, they might be on that more safer side and leaving money in the bank possibly more than other people that have these records of what they need to keep in reserves, I guess.
Yeah, absolutely. And my advice is, when I'm talking to a doctor's thinking about a startup, or maybe they have a project fully underway, all right, and we visit, I do share with them, without really knowing much about their project, I'm just certain that initial break even is going to be somewhere between 20 and 25K. So in my opinion, with the startup, on day one in the bank account, they're going to want between $50,000 and $75,000 in that bank account, and that is between 2 and 3 times their initial break even. And that's something to think about when you're talking with the bank on the loan. Is that initial working capital can be funded by a cash injection from the owner savings, or a lot of times the banks will work in, they know the new business needs some working capital, and so maybe they'll have a provision in the loan to provide some working capital. But I believe very strongly that a new startup on day one needs between 50 and 75K. That will provide a level of comfort, because trust me, the doctor's going to have enough on their plate right in that first 3 months getting the practice going. You don't want to be stressing about cash. I have worked with doctors where they either didn't have the working capital in the loan, or they were counting on some free rent and the project got delayed, and now they're paying rent before they're open, and it winds their working capital down. And so they're on day one, they're starting their practice with like $15,000 in the bank. And it is a total nightmare. It is a really stressful experience for those doctors, because the only way to build that cash reserve is to not distribute profit. You have to build it up, which means you're working as an owner, you're working without compensation for a while. And that's where that whole risk and
Mm-hmm.
reward is. If we circle back to the very beginning of our conversation, that's why, when you own a business, there has to be that appropriate reward, because sometimes you go through some hard times, building that practice up. And I think employees sometimes might lose sight of that down the road. They see the doctor making a lot of money and say, well, isn't that nice? Why, how come they make that kind of money? Well, they went to dental school and made that investment to have that earning power. But also, as an owner, you might say, well, hey, remember back when the practice first started, I didn't get paid for 6 months. It's risk and reward. Um, so yeah, I would say, yeah, with a startup, you want to have an ample amount of money, and in my opinion, it's about 50 to 75K. If someone's looking to buy a practice, it's sort of the same methodology. If they're buying that practice I've been talking about in my example, 85K per month with a 50K break even, I think they'd want probably $50,000 in that bank account on day one.
That is good. And I appreciate the specific figures. I know that's one of my pet peeves when people are talking about the business aspects of dentistry and they're a little too vague. So I appreciate at least some real ballpark figures.
Oh, sure. And those are very real figures. We see that
Yeah.
every day.
So while you were talking, I thought of a couple questions that, again, have just kind of always been on my mind as a student. I honestly don't know too much about the business ownership or taxes. So, when someone is purchasing a practice that already exists, so they're buying it from a different owner, how does that LLC get transferred to you? And if you're taking out a loan to be able to buy that practice, is that like a
Mhm.
business? Does that go towards the business or is that
Yeah.
considered like your own personal debt?
So when you buy a practice, you're not actually buying that the previous doctor's entity. So the vast majority, every deal I have seen over the last 11 years has been what's called an asset purchase agreement. So if you're looking at a practice and you're going to buy it, what you're really buying is you're buying that doctor's used equipment. You're purchasing a non-compete obligation from them, so you don't buy their practice and they go set one up next door. And then you're buying their patient list, right? So that if we're going to boil that asset purchase agreement down to three things, you're buying their stuff, you're buying their patients, and you're buying a non-compete from them. You're going to then take those assets that you just purchased and you're going to hold those and place those in your brand new PLLC that you just had formed. And so those assets are now held in your company. On the closing date, the seller is going to lay off all their employees. And then as the buyer, you're going to simultaneously hire them as employees in your brand new PLLC. And then the business debt, to answer your question, say we got the loan from like Wells Fargo, that is going to be that brand new PLC is going to be kind of named on the loan paperwork there, and you're going to make that practice loan payment from the operating account of your brand new PLLC, and the interest expense, of course, is fully deductible as a business expense within the practice.
So for that process, what kind of professional would you be working with? Are you working with a lawyer, a financial planner?
Yeah, you need, I think, as a buyer, in my opinion, you need a good attorney, a dental specific attorney that has helped with transitions, right? Because they're going to be able to form the entity, the PLLC, and then they're going to be able to advise on the contract. When it comes time to reviewing that asset purchase agreement and providing advice, that's practicing law. That is not something your accountant can do for you, not something a financial planner can do. So I think, as from the buyer's perspective, you need a good attorney that, like us, only works with dentists, and then they can help with the entities and help advise on that purchase agreement. The seller, on the other hand, and realize that that's probably not the core audience here, but the seller, then they should consider working, I think, with the broker, because you're gonna need an independent third party valuation, to decide what that practice is worth and help. So they likely want an attorney as well, but they're probably gonna bring a broker in also. But as the buyer, yeah, you need to find an attorney to set up the entity and help you review the contract.
If there are any dentists listening that are looking to get into ownership and go through this whole process, if they were interested in working with your accounting firm, do you have like recommendations for dental specific attorneys that you offer to your clients?
Yeah, certainly.
Okay.
I know a few that I can refer to. We have a national client base, so the attorneys I know also kind of work coast to coast, and I can make some recommendations. Um, Over the years, I can help with some due diligence. We do not do formal valuations. As I said in the beginning, I just got to be careful about wearing too many hats. Valuing a practice is kind of very specific. It's more than just a percentage of what they collect every year. I mean, you really got to go in and look and what's the facility like, what's the equipment worth, what is the composition of the patient base? Is it Medicaid? Is it fee for service? There's a lot that goes into that valuation. So we don't provide an opinion of value on the practice. But what I can do, and what I've done for years, is if doctors looking at a practice, I'm very happy to look at the seller financial statements, and based on what they're representing, I can provide some reasonable expectations on income and if there's any red flags I'm seeing. And I've done that for years, and my objective is, I want to have a long-term relationship. If they go through with that purchase and buy it, I want to be their CPA and support them year round, with monthly practice profitability analysis and tax planning. So I help with due diligence along the way, but I certainly do not replace the attorney or the valuation specialist.
For your accounting firm, do you foresee it to continue to grow? I know you were saying you have around like 20 other accountants working for you right now around the country. Do you see that
Mm-hmm.
continuing to grow, or are you going to kind of max out at a certain point?
No, we grow. There's no max. With our company, there's three owners. So I co-founded the firm with my dad Ken, who's still very active in the firm, and then we brought our longtime tax manager Courtney on as a partner about 4 years ago, which has been tremendous. So there's three owners, and we're up to closer to 30 employees, and so we just continue to scale and grow, and there's no limit. We'll keep growing. We've been very disciplined, however, in really just staying in our lane, staying in our niche. Because I get asked sometimes, well, why don't you guys do this for veterinarian or optometry or whatever? And it's like, well, I just don't know anything about those businesses. I know dental practices inside and out. So we stay like very strictly within our niche, and so we will continue to grow and scale and hire the right people to help us grow. And so we've enjoyed, very steady growth, over the last 11 years. And I think that's because we do stay true to our very specific mission, and we just try to do one thing and try to do it really well and better than everyone else. So there's no limit. We're never going to say we're full. We're always going to keep going.
Nice. That's good to know. Again, I was just curious. So I have one more question before we wrap up here, but just to get people's brains kind of thinking, can you share like one of your most commonly used areas for tax avoidance for practice owners?
So tax avoidance with practice owners, a big ticket item is what we've kind of talked about briefly already, and that is, once a practice, and it could be if you buy a practice that's already fully profitable, or if it's a startup, it's going to take a year or two to get it there. But managing the tax classification is important, because if when you have that PLLC we've been talking about, and let's say we start as a sole proprietor, which makes a ton of sense. That's how you want to be taxed as a startup in the very beginning. But the profit, so there's a couple ways that profit is taxed, right? All of our clients have what's called a flow-through entity or pass-through, and I know people have kind of heard that terminology. All that means is what a business tax return is for an S corp, a partnership, or sole proprietor is simply an information return. We're simply tabulating the taxable profit that practice produced during the year, that's going to flow through or pass through to the doctor's personal tax return, right? Their joint or individual personal tax return. And that taxable profit is going to get listed on page 1 of the 1040, and we're going to add it up with any other income, and then they pay tax personally one time. So with that taxable income that gets tabulated on that business tax return, you're going to owe federal income tax, state income tax, if applicable, depending on what state you're in, but you also owe self-employment payroll taxes on that total amount. Now, when we're first starting out, it's not necessarily material. As a sole proprietor, there's a lot more flexibility to deduct all those first year losses, the equipment, all that big investment. But once you're up and running, and we're practices making $300,000-$400,000 in profit, which is very common, we see it all the time. There is self-employment payroll tax due on that full 400,000 if we don't do something about it, and that's where that making that S election at the appropriate time can produce significant tax savings, because as an S corporation, we set that reasonable salary for the doctor. You pay your payroll taxes on that reasonable salary, and then the balance of the profit that's earned, you take home via distribution, not subject to payroll taxes. That's significant tax savings. That you got to pay attention to it. You got to set that salary at the reasonable, appropriate level, and it can yield some significant savings. So that's a big ticket item, step 1. We get into it with our clients. There's many other things that can be done as a business owner to avoid tax. Home office, some auto deduction, annual board meetings. There's lots of creative things that can be done to whittle away at that tax liability. But I would say this, Haley, I'd say the big thing to keep in mind for your listeners when we're thinking about, as a business owner, avoiding tax, I'll just be very upfront and say, look, there's no magic bullets out there. And there are some unscrupulous tax people out there that will prey on that perception that there's some big secret out there. Only I know it. And your accountant probably doesn't know it, but I know the big secret, and we're going to save all, and that is total BS. Mm-hmm. There are no secrets in the tax code. The tax code, Internal Revenue Code, is probably the most researched document in history, right? Everybody knows what can be done, right? There's no big obscure structure, some crazy thing. If that did exist, I would certainly do that for myself, all right? But that doesn't exist. How you go about achieving substantial tax avoidance is you have to do multiple strategies every year. And the accountant can't just do it all for you, right? The strategies that have to be executed at the owner level. For example, if we say, look, you need a board meeting for your S corp, so go take a 4-day trip somewhere. We'll name your spouse as an officer of the entity and just have the whole thing be tax deductible. And it's a trip you would probably take anyway, but let's just make the whole thing tax deductible. Like, we can recommend that, but ultimately the doctor has to do it. That's one example. How you save big on taxes is you have to do each and every one of those strategies, and you have to do them every year. Each strategy is going to take a bite out of that tax liability. It's not going to be a windfall in taxes, but it's going to help. And then at the end of the year, once you've executed all those strategies and you add them all up in the aggregate, that is how you get to your big number. So that is how tax savings is achieved. It's not some just magic bullet the accountant pulls out and says, I'm the only one that knows this. That's total nonsense. You have to be disciplined, and you have to do it. You have to do it all every year. And when you hire a CPA, to help with taxes, what you're really hiring is somebody that knows these strategies, and the information's out there, right? We all subscribe to professional resource materials, just like doctors. So those strategies are out there. You want to hire somebody that's going to do them and going to help you with them. But that is how you go about tax savings.
Well, thank you so much for all of that insight today. I know I learned a ton, and I'm sure most of my listeners did as well. Is there anything else you want to share with the listeners before we wrap up?
I think we've had a good discussion. I would say that, if your listeners are thinking about, like, it's intriguing, like, do I want to own a business? I would say that, the income potential as a business owner will always, I think, will always eclipse earning potential as an associate. A really good friend of mine um, bought a practice last year, had worked as an associate for a long time, and decided that the time was right to move into ownership, bought a practice, and it was a nice practice, paid, good amount of money for it. But and he purchased it last fall, right? So his first month of ownership was September. In the last 4 months of 2020, he made more money in that 4 months than he ever made as an associate. And he's absolutely killing it this year. But he went down that path. He had associated for a long time. He paid attention to how those places were run, what he liked, what he didn't like. And so he was very capable. When he stepped into ownership, it's been run very well and he's enjoyed a lot of success. So I tell that story that, definitely associate, in my opinion, somewhere for a few years, be a sponge. And then if you're up for it, if business ownership sounds appealing, the rewards are there. I mean, they are. I see it every day. The income potential much higher as an owner. So I guess that's the last thing I'll leave you with.
Well, thank you so much for your time today. I really appreciate everything.
No, it was my pleasure. I enjoyed it. Thanks for having me.